Welcome to yet another episode of Financial Insights in Minutes,
where we summarize the day's top financial videos to save you time.
Today, we delve into some pressing financial dilemmas.
Are we on the brink of a recession with global markets in turmoil?
Expert predictions about market stability and what that means for your investments await.
Let's jump into today's insightful summaries.
First, Danielle DiMartino Booth explains the global market meltdown and its ties to the Fed. Next, Michael Gade discusses the implications of the yen's reversal and credit risks. Jeff Snyder outlines Japan's crisis as a global warning sign for financial stability. Then, Lance Roberts analyzes the reasons behind the recent sell-off in markets. Chris Whalen shares insights on the rising concerns about credit and institutional retreat. Noel Smith breaks down the factors contributing to the stock market crash. Jeff Gundlach warns of a serious recession looming due to distress signals in the markets. Finally, Joseph Wang updates us on the latest tumult in U.S. and global markets. Welcome to Kitco News. Today's hot topic, the global market meltdown, with major indices crashing and fears of a recession looming large. Joining us is Danielle DiMartino Booth, the CEO of Chi Research and a former advisor to the Federal Reserve. Perfect timing for some critical insights.
Absolutely. Danielle has a knack for dissecting complex market dynamics. She's here to unravel the factors behind today's chaos and what we might expect from the Fed.
So, what's the main takeaway from Danielle's analysis of the market meltdown?
The core thesis emphasizes that a perfect storm of conditions, including fears of a recession and international instabilities, has set off a seismic shift in the markets. The Fed's inaction amid these signs is a focal point of concern.
Let's dive into those key points. What's going on in the markets?
The S&P 500 dropped over 3%, getting alarmingly close to correction territory. The Nasdaq 100 has already entered that territory, highlighting the severity of the situation.
And what's fueling these recession fears?
A disappointing jobs report from July has amplified concerns about a potential U.S. recession. Additionally, geopolitical tensions, especially in the Middle East, are escalating fears and market volatility.
What's the Fed's involvement in all this?
The Fed is facing significant criticism for being behind the curve. Danielle predicts they'll have to offset the market turmoil with a substantial rate cut. In her view, maybe 50 basis points could be the starting point.
Japan seems to be in the mix too. How's the situation there?
Japan's market recently saw its worst drop since 1987, especially after they reduced quantitative easing, signaling a massive shift in liquidity that's shaking the global foundation.
What predictions does Danielle have for the Fed's next move?
Danielle foresees potential rate cuts by the Fed as early as September, with a 50 basis point cut being an increasingly likely scenario given the economic pressures.
Any further predictions on market stability?
Yes, with geopolitical risks and ongoing volatility, Danielle suggests the risk of contagion to credit markets could lead to continued sell-offs unless addressed.
What are the major takeaways as we wrap up?
In conclusion, there's a pressing need for strategic shifts from the Fed to manage mounting economic challenges and stabilize the turbulent markets. The call for decisive action has never been clearer.
Welcome back to the David Lin channel. Today we're diving into an exciting discussion on the future of global markets and the yen. Joining us is the ever-insightful Michael Gade, publisher of the Lead Lag Report. He's been ahead of the curve predicting economic shifts, and he's here to break it down for us.
Definitely. Michael's knack for spotting market trends is unmatched, and his previous predictions have earned him quite the reputation. Let's jump into the juicy details.
So what's the central theme of today's discussion?
The core thesis suggests that the yen's reversal in the carry trade is just the tip of the iceberg. It indicates deeper issues, namely the repricing of default risks in corporate credit as recession fears loom larger.
Let's navigate through those key points. What's the deal with the yen carry trade?
The reversal of the yen carry trade is sparking wild fluctuations in the markets. The Bank of Japan may have to intervene soon, which could cause ripples across global financial systems.
And what about corporate credit?
Prolonged leverage presents serious risks. We're witnessing early signs of rising default risks in corporate credit, which aligns with what's typically seen before a recession.
What should we expect for the future of the markets?
Expect continued volatility as markets react to shifting economic signals. Interventions by the Fed may not have the desired effects and could worsen the situation instead.
What are the big predictions Michael has made?
He believes heightened market volatility will persist. Investors should be wary of sudden downturns as indicators point toward deeper economic challenges.
And how might the Fed influence all this?
If the Fed intervenes, it might actually exacerbate the issues, particularly pushing the yen further down, which could lead to more turmoil.
To wrap it up, what should our viewers take away from all this?
The bottom line is to stay cautious. Ongoing volatility in the markets is expected, and investors must remain alert to changing trends in corporate credit and potential Fed responses.
Welcome to Eurodollar University. Today we're diving into a seismic shift in the financial world triggered by Japan's massive market meltdown. The question is, how will this affect the global landscape?
That's right. Jeff Snyder breaks down this turmoil in detail, highlighting the interconnectedness of economies. Buckle up, folks. It's going to be a wild ride.
So what's the big thesis coming out of Jeff's latest insights?
The core thesis is that Japan's financial crisis isn't just a national issue, but a global warning. It's shaking the very foundations of the belief in a soft landing for other economies as well.
Let's dissect the key points. What's happening on the ground in Japan?
Japanese stocks are experiencing a catastrophic drop, losing over 20% since July 11th. Margin bets on these stocks have reached levels we haven't seen since 2006.
And what does this mean for global markets?
The fear is that a potential recession will send shockwaves through global markets, forcing liquidations in the credit market and beyond.
There seems to be a bigger picture here. What are investors finally realizing?
Investors are waking up to the fact that they've been overly complacent about market risks. The narrative that the U.S. economy is resilient is now under serious scrutiny.
What does Jeff forecast for the markets ahead?
Increased volatility is expected as markets grapple with these new realities. Non-Japanese markets will likely feel the pain too.
And what about the long-term view?
A reevaluation of economic conditions is on the horizon. Investors will need to confront the uncomfortable truths about their risk perceptions.
To wrap things up, what are the essential takeaways?
Japan's crisis is a wake-up call. It's a signal for global investors to reassess economic fundamentals and sharpen their understanding of risk in a rapidly changing landscape.
So is it all doom and gloom?
Not entirely, but it's a time for caution. Investors should prepare for potential downturns and rethink their strategies moving forward.
Welcome to Thoughtful Money. Today's urgent topic: what's causing the recent sell-off in global markets? We've got financial wizards Lance Roberts and Jonathan Whalen with us to navigate these turbulent waters.
Indeed, as markets have plummeted 3 to 5% over just a couple of weeks, delving into the catalyst behind this is essential. Understanding these waves of market dynamics is crucial for investors.
So, what's the core thesis behind this market chaos?
The main idea is that the markets were overbought, and as the yen started appreciating, it triggered a wave of margin calls, leading to a significant sell-off.
Let's dive into some key points. What happened with these market corrections?
Lance notes that the market corrections were expected due to overbought conditions. A healthy market often sees declines of 5 to 10%. This sell-off was just the market reverting to norms.
What's the role of the yen carry trade in all this?
The yen's rise has resulted in forced asset liquidations, as traders who shorted Japanese bonds are getting margin calls, exacerbating market declines.
And what about the investor sentiment?
The Volatility Index, or VIX, saw a significant spike, showcasing just how reactive and fearful investors are right now.
What does the crystal ball say about market predictions?
Experts suggest that we might experience more volatility. Investors should remain cautious as the markets adjust to these corrections.
Is there hope for a market recovery?
Absolutely. Historically, markets tend to recover after these phases, and savvy investors are salivating over potential buying opportunities.
To close the loop, what's the key takeaway?
Investors need to reassess their portfolios, understand their positions deeply, and perhaps get professional guidance to weather these uncertain times.
Welcome to the Julia LaRoche Show. Today, we're diving into the intriguing topic of economic challenges ahead with none other than Chris Whalen, chairman of Whalen Global Advisors.
That's right. Chris brings a wealth of knowledge as an independent investment banker and analyst. Buckle up as we navigate these choppy economic waters.
What's the core message Chris is bringing to the table today?
The thesis centers around rising concerns about credit as institutional investors shy away from risk, leaving retail investors exposed at a critical turning point.
Let's break down those key points. What's happening with the credit market?
Chris outlines a significant retreat from credit by institutional investors, pushing retail investors to the forefront, potentially leading to risky situations.
And what's happening on the consumer side?
There's an underlying tension with credit defaults poised to spike, especially among lower-income households struggling with inflation and rising costs.
What does Chris say about the potential recession?
The Fed is indicating significant concern through stress tests, and the political landscape adds to the economic uncertainty.
And what are the implications if the Fed cuts rates?
Whalen suggests long-term rates might not align with Fed cuts, and we could see an uptick in corporate defaults during this turbulent phase.
So, what predictions are on the horizon?
Chris foresees an increase in corporate defaults and tighter credit conditions for consumers, exacerbating the looming economic turmoil.
What about market reactions to the upcoming election?
The election year brings potential volatility, with rising anxieties surrounding consumer credit that could impact markets significantly.
In closing, what's the big takeaway?
Chris urges for a cautious approach to credit, indicating that navigating the challenging economic landscape will require vigilance and strategic thinking.
Welcome to Blockworks Macro. Today, we'll dive into the tumultuous waters of the global stock market crash, and joining us is volatility expert Noel Smith. Strap in as we unravel the chaos.
Absolutely. The markets have taken a nosedive, and Noel's insights on volatility are incredibly relevant right now. His expertise from Convex Asset Management will help us navigate this stormy terrain.
So what's the core thesis behind today's market uproar?
The main thesis is that the recent sell-off stems from a combination of recession fears, significant sell-offs in Asian markets, and a volatility spike that has traders scrambling.
What are the shocking statistics behind this drop?
Well, the S&P 500 plummeted as much as 4.5% today. The Japanese market saw a whopping 12% decline, marking its biggest drop since 1987, while Taiwan faced its largest one-day fall since 1967.
What about the volatility index, or VIX?
The VIX surged to 64.65, implying that traders were expecting daily movements of around 4% in the S&P 500. This level is reminiscent of crisis conditions.
What specific factors contributed to today's chaos?
Well, fears of recession linked to a disappointing jobs report, coupled with the unwinding of the yen carry trade, have really piled on the pressure, while many volatility traders were forced to cover their shorts.
What does Noel anticipate for the coming days?
He predicts that without a reduction in these volatility shocks, a market recovery isn't on the horizon, with the potential for continued selling pressure, especially in Asian markets.
Any long-term thoughts about volatility?
Absolutely. If recession fears deepen, high volatility may persist. Market dynamics are poised to shift dramatically, leading up to key economic events.
So, what should viewers take away from this discussion?
Immediate recovery appears unlikely, with volatility spiking and macroeconomic fears looming. It's a time for cautious navigation and informed trading strategies.
And any final thoughts for our viewers?
Yes, investors should remain vigilant, monitoring volatility trends and macroeconomic indicators as they unfold. It's a risky sea out there.
Ahoy, money navigators. Welcome back to MHFIN, your go-to port for financial wisdom. Today, we're sailing into uncharted waters. Jeff Gundlach's shocking warning about the looming 2024 recession.
That's right. Gundlach isn't just stirring the pot, he's got some serious economic insights. As CEO of Double Line Capital, his track record in understanding market dynamics is top-notch. Let's dive deeper.
So, what's the main takeaway from Gundlach's warning? It seems we're not just dealing with choppy waters here.
Exactly. Gundlach's core thesis suggests a serious recession is on the horizon, citing a perfect storm of high interest rates and troubling market signals that cannot be ignored.
Let's break down Gundlach's key points. What's happening with those tech stocks out there?
A painful sight. Tech giants are indeed wobbling. Google has plummeted by 33% from its peak, while Nvidia and Amazon aren't far behind, down 19 and 16%, respectively.
And what's the deal with interest rates?
High interest rates act like gravitational pull on market prices. They keep borrowing costs high, affecting everything from homes to groceries, and now stocks.
Interesting stats there. What about predictions based on economic indicators?
The SAM indicator, which boasts a 91% accuracy, is lighting up red again, signaling a looming recession potentially as soon as September of next year.
What about the big players like Buffett? Any insights?
Absolutely. Buffett has famously sold 55% of his Apple shares and now sits on a whopping $277 billion in cash. This move certainly raises eyebrows.
What does Gundlach predict moving forward?
He anticipates further market destabilization and potential panic that could ripple through banks and job markets, suggesting that stakeholders need to brace themselves for impact.
As we sail towards the conclusion, what should viewers be taking away?
Gundlach urges everyone to pay close attention to these economic signals. It's crucial to be aware as the currents shift in the financial waters ahead. Stay alert, folks.
Any last words for our viewers before we dock?
It's all about maintaining caution and preparing for the unexpected. Remember, being informed means you won't be caught adrift.
Welcome to Joseph Wang's channel. Today is August 5th, and we've got an emergency market update hot off the press.
Absolutely. Today's session is packed with urgent news, especially focusing on market movements both in the US and Japan. Joseph dives deep into that water.
What's the core thesis behind this emergency update?
The major takeaway is that a staggering 12% drop in Japan's Nikkei index has reverberated globally, causing turmoil in US markets as well. Joseph highlights a cascading effect rooted in global leverage.
Let's break down some key points. The US market isn't looking too good, is it?
Not at all. The S&P 500 is down about 3%, and at one point, NASDAQ futures dropped close to 6%. That's enough to make any trader sweat.
And how about the disaster happening in Japan?
The Nikkei index experienced a jaw-dropping 12% drop today. Joseph aptly calls that a legitimate stock market crash, a wake-up call for everyone.
Can you explain how global investors are involved in this chaos?
Sure, with Japanese investors facing massive losses, they're compelled to liquidate positions, which in turn impacts the S&P 500 and other markets due to the interconnected nature of global finance.
Now, let's talk about that VIX spike.
Right, the VIX soared to 60, an alarming number. Historically, such spikes are tied to major market turbulence, and this one could be no exception.
Amidst all this chaos, is there any positive data we should keep an eye on?
Indeed. The U.S. Services PMI indicates expansion in the largest sector of the economy, along with strong employment signals. That's a glimmer of hope.
What can be expected in the coming days?
Joseph predicts a continued sell-off, influenced by heightened caution among investors. The psychology in the market shifts, which can prolong recovery time.
And the Fed's role in all this?
Joseph anticipates no emergency rate cuts, explaining that at a 3% drop, there's no immediate alarm. However, gradual rate cuts are on the table as financial markets need support.
So, what's the big takeaway from today's emergency update?
In summary, while today's market turbulence reflects typical deleveraging cycles, optimistic economic indicators suggest that, although we're hit hard today, recovery could be on the horizon if managed carefully.
Final thoughts for investors.
Staying cautious while keeping an eye on those economic indicators will be key. Buckle up, folks, it's going to be a bumpy ride.
In today's discussion, agreement surfaces on the rising concerns about economic stability, led by Danielle DiMartino Booth's call for decisive Fed action.
Michael Gade's focus on yen fluctuations and their credit implications presents a shared anxiety for the markets ahead.
Yet, differing views on the speed and method of intervention highlight varying strategies among experts.
It's clear vigilance in investment is essential as we navigate these uncertain times ahead.
Thanks for watching Financial Insights in Minutes for August 6, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.